Thanks very much. It's always a little bit daunting to be on the agenda after John Gray, so we'll certainly try to do our best here. The topic of this panel is actionable trends and developments, getting ahead of the curve, which I'm not really sure exactly what that means, other than it's kind of a catch-all for just about anything here. But we'll try to keep on topic. And maybe we'll just start out with a little kind of discussion around the current environment, and maybe up front just hit the elephant in the room, which is interest rates. We're basically coming off about a 40-year cycle of declining interest rates, literally straight for 40 years. It's probably been all of us around the room pretty much our entire careers. And that stopped about a year and a half ago. And notwithstanding everybody's sort of resetting, we've continued to see a lot of volatility in the rate environment. So if you look over the last 6 months, we've gone at the short end from expectations that there's probably going to be 7 Fed cuts this year to now an expectation that maybe 1 or 2. And on the long end, over the last 6 months, we've basically gone from 5% long 10-year interest rate down to 3.75%, and now back up to 4.6%. And even in the last 2 weeks, it's literally been about a 50 basis point move. And notwithstanding, we just heard from sort of John's comment and view that a lot of this is really noise. We know the direction of travel. We hopefully know the direction of travel in both inflation and rates. It is still a lot of volatility. And so I guess the question for our panelists, and maybe Eric, we'll start with you, is John's given us his perspective from a private equity standpoint. As a public company, public REIT CEO, how does the environment and that change and that volatility impact your business, how you see both the strategy in terms of opportunities on the asset side, but also the liabilities?
Well, I think that to really position a public REIT balance sheet for the opportunity set that arguably we're going to have over the next year or so, next couple of years, we've always approached balance sheet management from the perspective that as a steward of shareholder capital, our job is to really protect our earnings performance and secure our platform and our ability to perform for shareholders through a full cycle, through a full interest rate cycle, through a full operating or economic cycle. And so what we've really embarked on a mission, it's been probably 15 or 20 years ago, to really deleverage the balance sheet, to really position ourselves to be able to access the public debt markets, and ultimately to create as much optionality and flexibility as we can on our capital structure, to be able to work through rising interest rate environments with a lot of options, a lot of opportunity to access different points or different pockets of capital. And then when you get into an environment that hopefully we will see over the next couple of years of lowering rates, it gives us the capability to be an early mover as opportunities begin to emerge, either as a function of rising interest rates or I should say more distress in the operating environment. But if when you get that up and down and the volatility in the interest rates, usually it triggers opportunities. And what you're trying to do, I think, with your balance sheet is just be in a position to be able to exercise a full range of options and be an early mover. And so, what we see happening right now with the trend of interest rates and what's been going on, we really actively deleveraged the balance sheet over the last 4 or 5 years in a time of very strong operating fundamentals for our Sunbelt markets and obviously very low interest rate environment. And rather than take the opportunity of that low rate environment to perhaps grow more aggressively than we otherwise would have, we actually deleveraged the company a good bit and began to build capacity on the balance sheet that I hope that we will have a lot of opportunity over the next couple of years to put to work.
I guess I'd just like to add a couple of things to that, Eric. When you think about rates, what's happening with rates, it's not about the absolute interest rate. It's about the predictability of that interest rate. And what's happening is a positive from my perspective, at least on the retail side. We're shopping center people. It's been impossible to buy anything over the past couple of years, and one of the reasons it's impossible. Imagine you had a good shopping center and you wanted to sell it. You're not going to sell it. The bid ask is too wide. What you're asking for that property didn't make any sense compared to really where rates were going to go, because nobody knew what they were. So today, with the Fed hopefully not raising anymore, even if they don't drop, even if they stay where they are, that allows potential sellers to say, okay, I got a pretty good idea of what the marketplace is. And so the bid ask, if you will, between buyers and sellers on the acquisition front is tighter than it's been in quite some time. There's some opportunities to buy now, to use that capital. And does that change to the extent rates start going back up again? Of course it does. Does that change if rates go down a bunch? Sure it does, because you're a seller and nobody wants to sell anything cheaper than they think it's worth. So it's a pretty interesting time, and I think we have a window here of, call it a year, 2 years, something like that, to be able to get some capital deployed rather than, nobody's developing, it's hard to make numbers work developing, it's buy versus build right now, so buy. Extend that capital, do it while the window's open.
Yeah, I would only add, it's about having a lot of options, flexibility, being well positioned, but there is tremendous benefit for public companies in having broader access to capital. So if you're trading at discounts, equity window may not be open. You have to look at other ways to raise capital. It could be JVs and other formats. In the debt side, there's secured debt. There's also various forms of unsecured debt. So really keeping options open and making sure you have a balance sheet that can back that optionality is tremendously important. So you're really trying to create an all-weather balance sheet as opposed to hitting it out of the park in any one part of the interest rate cycle.
Sense.
So you talked about some of the acquisition opportunities, environment, and let's talk a little bit about distress in the market. All you have to do to see the headlines is every Wednesday open up the Wall Street Journal and there's an article on distress in the office sector. And increasingly maybe a little outside of the office sector as well, probably some in the multifamily market, just given where frothy valuation levels, where some assets were financed. But on the ground, is this distress, like how much of it is it going to be? Is this overhyped, or is it the reality, and does it present opportunities for you? Maybe as the office
target.
We'll start with you at least.
So it does seem distress should come. The headlines are very negative, but I think there's a couple of items that are worth clarifying. One is in the office sector, it's a capital markets dislocation issue first and foremost. Rates went up really quickly and lenders aren't fully available in their typical capacity. So that's issue number one. The second item is it's a story of haves and have-nots. If you've invested well, you have modernized assets, you're ahead of the curve, you offer some sort of value proposition for your tenants at a price point, right? Like this space makes sense for you to build your employee base and do your work, then you do okay, and you're seeing that in leasing activity. The flip side of that is if you have not invested well and thought ahead about your assets in the last 5 to 10 years, you're certainly not going to start in 2024 when interest rates have tripled and cost of capital is high and the ROI on investing in your assets is questionable at best, right? So that leaves a pile of haves and have-nots, and all of that is getting really murky. So that then affects the banks because credit committees are having a really tough time with the word office, right? How much exposure do you have? And what's going on with the money center banks, and the Feds, they're actually very healthy, but the Fed is saying 3 things that are somewhat contradictory. First, they're saying, how much commercial real estate exposure do you have? You shouldn't have that much. So that's, restriction 1. The second item is what kind of marks are you going to take, but keep a careful balance of get them to the right marks, and then also let's not create an issue for the regional banks. And then the third one is just, do you have the right mark to markets, and we don't really have transactions to see. So all of that means there's not enough debt availability. There's a ton of kick the can down the road. So that's preventing us from seeing the true reality reality, all the distress that matches the headlines. So at some point it should happen, but it needs to clear up what could cause that. Perhaps CMBS, because the Fed isn't dictating what special servicers can do right now. They may have enough reserves, may have enough protective advances, and they can kick the can down the road. At some point, these bonds mature, they run out of reserves, and then things start hitting the market. You're starting to see early signs of it, but not nearly as much volume as would match the headlines.
Maybe I can speak to the multi side, and I would frame it more as there's stress, not necessarily distress. And I do think the headlines paint a, more of a doomy, gloomy picture. On the multifamily side, what I would say is it's really two buckets. There's a ton of tailwinds in rental housing right now, ton. Affordability is so low. And even if you think about the general shift in generations, it's not necessarily, millennial and Gen Z and beyond's goal to buy a house one day. And so people are more mobile. That's kind of a shift with COVID. You maybe can be more flexible in your work and work from a different location, try out new cities. There's definitely parts of the country where we're seeing rent contraction in apartments and housing because of oversupply. But it really is also an opportunity for buying. And so kind of to the point of the first question, understanding the landscape right now is really important. Those with access to capital are going to be able to take advantage of some of these really interesting opportunities, perhaps in the Sun Belt where there's a lot of stress and maybe even distress right now. There's going to be very interesting buying opportunities for the future. But the balance of some of these markets and submarkets in the housing sector are actually doing pretty well. And I would say, the COVID correction period is over. The rent growth that we were seeing over the course of the last few years was just phenomenal and abnormal. So that's not coming back in any way, shape, or form. So we're starting to see things normalize. This year will be interesting, I think, just because of the blended basis of what's going on in some of these oversupplied areas. You might even have some negative overall rent growth in apartments, but it's coming back. I mean, the tailwinds are just too much, and that goes for all of the rental housing sector.
I would just echo the comments that you made there, at least as it applies to the multifamily space. We don't see the level of distress that people thought maybe a year or 2 years ago we were headed for. And really, I think it's because as you think about sort of what creates stress, at least from a supply-demand dynamic, the thing that can really cause distress, real distress, is a demand drop. And if people are not wanting to buy what you're trying to sell, that's a real problem. And that can create some real downward movement in values and performance. What we see playing out right now is really a supply-induced cycle, but the demand is still there. And it's going to take a little time for the demand to absorb that level of supply, but it's doing so in a pretty orderly fashion. And so as a consequence of being a supply-induced down cycle as opposed to a demand-induced down cycle, we actually see values holding up pretty well. And the only two pockets that we see where maybe some level of higher levels of distress are existing is some of the properties that were acquired or portfolios that were put together starting 4 or 5 years ago at some very lofty valuations at some incredibly low interest rates. Now, some of those scenarios are going to be problematic and difficult to unwind, but more often than not, we find that the asset quality tends to be at the lower end of the product spectrum, and we generally don't play in that particular area. There will be some opportunities in that area, though.
So let's talk a little bit about that on the demand side. And Dana, you said we're kind of through that COVID recovery period. So we're now more than 4 years after the onset of COVID. So hopefully we've kind of, at this point, figured out, what impacts there have been. And I guess the question, maybe, Don, you can start on this, is what has been the change in consumer behavior, the more permanent versus the temporary change, and how does that impact how you think about your asset base and your store mix, et cetera?
The impact on the consumer, to me, is one of the most interesting parts of kind of what's happened to real estate over the past few years. And, you know, there's a couple of components to this. The first one that's really interesting is people aged 50 to 70, the people who have created some level of wealth, something, and I don't mean rich people, I just mean, you know, good jobs, upper middle class, have put some money away. There used to be much more attention on taking that wealth and passing it on to the next generation. And we see a palpable difference in those folks spending, and they spend instead. And I guess you could understand that happening coming out of COVID and, you know, was such a mess and figuring out what that means. But it's 2024 and it's sustained. And so you see that spending in entertainment, you see that spending in travel, you see that spending certainly in food and beverage restaurants. Wouldn't you think by now that restaurant sales would have cooled off, bar sales would have cooled off? No way. It's as strong as it's ever been. And very interestingly for us, coming out of the great financial crisis in 2008 and 2009, I would have thought we were worried that the restaurant and food sector of our business would be hit the hardest. It's obviously, it's not necessity-based. Why would you still do it? It was our strongest category in 2009, 10, and 11. And we're seeing the same thing again. Now, so I'm not sure it's specifically COVID-related, but it's that realization of, you know what, I got one trip through here, let's enjoy it. The other thing is, work from home is real. Work from home, whatever that means, to whatever company, any way you look at it, I believe the consumer is far more focused on lifestyle balance than they've ever been. And that lifestyle balance means, when I'm not working, what am I doing? How convenient am I to work? How do I stay out of traffic and not be sitting in the car? We're seeing the difference between our mixed-use properties, which are first-ring suburbs in some major markets where there is office, there is retail, there is resi, there's a hotel. They're far exceeding the growth coming out of COVID. They're hit harder in COVID, but far exceeding the growth coming out of COVID. It's a convenient lifestyle. And that just seems to be, from a consumer's perspective, different than it was earlier. It's incremental demand.
To that point, actually, what's interesting in the hospitality sector, which obviously suffered the most probably during COVID, is because people have these flexible work schedules now, they're taking long weekends so they can work remotely on a Friday or a Monday, and hotel ADRs on Thursday and Sunday nights are just significantly higher than they were pre-pandemic. And you know, whether that's here to stay is questionable because not everyone can kind of take a 3-day weekend every weekend, but we're starting to see business travel really come back in full force, and that's going to be there to stay for sure. I would say the logistics sector also is just experiencing something that's a true shift. And you know, it has a lot to do with e-commerce, but also just our lifestyles have changed so much. We're so used to being able to get something same day, next day, that week, whatever it is. So you have retailers that historically were holding just-in-time inventory that are now willing to go to just-in-case inventory and hold on to more. You also have, you know, the logistics space and retailers really absorbing e-commerce and what it's done, and realizing that $1 billion in sales in e-commerce means you need 1 million square feet of warehouse space. And those e-commerce retailers want to hold on to, you know, 3 times more inventory, or they will, than a traditional retailer. So I think that's also been a sector that you just see future change in post-pandemic. Also nearshoring, onshoring, everything happening on the manufacturing side, and the tailwinds behind that with the infrastructure bill kind of coming. When development starts again, a lot of it's going to be in the warehouse space, I think.
So I liked John's comment. I'm going to actually coin that now, which is work from work rather than work
that's
from
me
home.
too, by the way.
That's a new one. But in that, and just riffing on the kind of COVID impacts, there's also a lot written about the urban doom loop. And frankly, sitting in my own office in the middle of Times Square and seeing the mass of humanity, it's difficult to actually understand what that means. But then, you know, go to downtown San Francisco and it's a little bit of a different story. Maybe I'll start, Dana, with you. As Brookfield's one of the biggest sort of CBD, downtown CBD real estate investors out there. Is it real, and what creates the difference between a downtown San Francisco and Midtown Manhattan, and what, as a business leader and working with government, how do you address the issues that we face?
I will say I really do think San Francisco has been so slow, but it is going to come back, and we're really just starting to see the cusp of that. But I would say it's more of an urban doom blip than a loop. And it really is, there's kind of two buckets to think about this. In 25 of the largest 26 downtowns in America, residency is higher today than it was right before the pandemic. People want to move to cities for a reason. And look, New York, we all live and work here. It's a huge example of that. I work downtown, Christina lives downtown. Anywhere where you can get that 24/7 vibe is going to be just fine. Violent crime, property crime is down in most of these cities. It's more today an issue of homelessness and open drug use, and I think that's been probably the biggest challenge for a city like San Francisco. On the flip side, there's these older, smaller cities. Cleveland's a great example where, because of work from home or flexible work, you've got your downtowns that, they tend to draw more of a crowd today because of sporting events more than anything. You don't have that 5-day work vibe going on. So a lot of the businesses in those areas are suffering. Property values are going down, but they don't have that much farther to fall. But when you're paying less in property taxes, it's a trickle effect. And so you don't have as much for the government to spend on public services like transportation and policing and schools. And that could lead to a lot of detriment in those cities. And I think it's upon kind of the businesses to understand it's a double-edged sword to a certain extent, because you have employees that want access to a bar after work, or a nail salon, or a place that they can go and gather with friends. And if you don't have that, they're going to be less inclined to work there. But more so on the government, and this is more of a challenge because, how much funding are you going to be able to get? But it comes back to, can you do little things? Can you rezone? Can you take a downtown that maybe historically was only meant for work and make it more a community, building housing, converting office, not the easiest thing to do, but into mixed use, or, into something else that just kind of brings people to the place and makes it a downtown where people want to live. So I think it's two stories, and there's definitely going to be potentially more pain and suffering coming for some of those smaller markets that still need to figure it out.
Maybe I did just want to add to that, and it probably applies to anything any of us say all the way through here. Real estate's a local business, man. And when you start painting everything with a big brush, no matter what the sector is, no matter what the location is, you may be missing the point. And I kind of think about this as you were speaking, Dana. I was thinking about D.C., Washington, which is where we work outside, and frankly, it's a mess.
Yeah.
And it's a mess for a lot of reasons, but certainly work from home is extreme there. We're in those first-ring suburbs. We see it all the time in terms of the benefit. If there are two lawyers who live in Bethesda, Maryland, who used to go down to D.C. to those law offices 5 days a week, and now they're not doing that, you know where they're spending that money? In the communities in which they live. So there is a dramatic changing of where the spending is effectively happening. When you throw on top of that crime, and it's a big deal, it's a big, big deal. If you don't feel safe where you are, spending stops. So it really is a tale, probably not of two choices, it's probably a tale of 20 or 30. Real estate's a local business. Just be careful as you invest.
I would just add on New York, I mean, we're all here, we can see the vibrancy, but what really drives that? I think New York has elements, it's a place where people want to work. So despite not having a government that is super pro-business and attracting businesses. Companies want to be here. You can hire talent. You can hire diverse talent across different sectors, and that's really important. People want to visit here, so we have the observatory business, and even though visitors, for the observatory are still about 75% of pre-COVID, we're back to our old numbers, and you can feel it in the streets, right? Tourists definitely have New York on the map, and that's despite a really strong US dollar, and there's a lot to do, and that draws visitors. So even as people say people aren't going back to work, they may not be in their office and at their desk 5 days a week, but they're definitely at the happy hours, they're definitely at breakfast meetings, they're definitely at dinner meetings, so you can really feel the vibrancy. So I think for all cities, having that combination of density to keep the riffraff and the crime down, and just having a lot of activity, work, live, play, those are really important, and you start to see that as being a key driver for real estate. That's why people talk about placemaking. That's why amenities are becoming a key feature across different sectors.
And following on something that, Don, you said, I think it really is, it depends on the market. It depends on the location in the city. And a number of these Sunbelt markets where we're invested, we do see some still, vibrancy in downtown, but a lot of the employment nodes and a lot of the employment growth that is taking place in some of these Sunbelt markets is really out. In Dallas, for example, downtown Dallas is pretty vibrant, but you go up north to Frisco, McKinney area, that area up there is going to have more office product and more office square footage than downtown Dallas. And what we're finding more and more is people are, with employment nodes increasingly pushing out a little bit in some of these markets, not all markets, but some markets, we're finding increasingly people want kind of an urban feel to the product, and so you're seeing a lot more of the structured parking deck, interior hallway, the more urban feeling to the communities and to the apartment product, and adjacent or retail is becoming a component of that as well, much like what you would experience in a downtown setting, but it's actually out in the suburbs because of the reasons you just talked about. Crime issues are still real. And people, we're finding a lot more people are working from home, staying in their apartments, working more so than they ever have, and I think that's continuing to fuel a lot of demand in a lot of these suburban locations.
Okay. So when we talked about some of the COVID impacts, and one of the things we discussed a little bit was e-commerce, the impact that has not only obviously on retail, but it's on every sector. In the same respect, you talk about the use of data and AI in particular, and all anyone wants to talk about in the real estate world is the data center phenomenon. That said, AI has an impact as well, and the proliferation of data on every space, including just from an operational standpoint, from your own operations. And I guess I'd ask you, Mary, Eric, you can start. What are the use cases? What is the business proposition? What are the things to take advantage of in terms of your own business from the proliferation of data and AI in particular?
Well, as been discussed this morning, I think it's nothing short of completely transforming our business. It is absolutely transforming how we interact and provide service to our leasing prospects, to our residents. One of the things that came out of COVID was the virtual leasing capability and the growing level of comfort. Maybe it's also just part of the demographic shift that's continuing to take place across the country. But our customers and our prospective customers increasingly want to, over 95% of the leases that we write originate online. And they come in, they already know what they want, they've already checked the price, and of course, in many cases, the complete leasing process takes place online now, and there's never a human intervention in the process. And so part of that is our consumer-driven factors that are causing that to occur. But what it's yielding is an opportunity for us to continue to also centralize some operations, as was touched on this morning, which is enabling us to create, I think, not only a more efficient operation for ourselves, but a more effective service for the consumers that we're trying to serve. But we will probably, we employ roughly about 2,400 employees across the country. We'll probably see half that in the next 5 years. go away. And so it's a significant transformation of how we do business.
Let me add one thing to that if I can then. But, as business leaders, we have to figure out how we're going to participate in something that is clearly transformative. And we're running real estate companies. And in a real estate company, I frankly don't want to be the first guy out in new technology, kind of ever. I want to be the second guy or the third guy. I want to see what's going on. So how do you participate in a technological advancement that is secular, clearly, and changing by the day? And what we decided to do, I'm going to make a little plug here for Fifth Wall, a venture capitalist fund that I think Brendan Wallace was actually speaking here earlier today. We decided to invest this way as a limited partner with access and understanding of what each of their investments, over 100 companies to this point, what each of them are doing. Because that many AI companies are going to fail. Many companies fail. So how do you, as real estate operators, pick the right ones, the ones that make sense in your business? And from my perspective, I want to see them first. I want to get involved with them, as many of them as I can. And that seems to be a pretty good way to effectively participate, because we're just at the beginning of the AI revolution.
I'll add just two things on the AI front. I agree with all the comments here on efficiencies. I think it also is a really good opportunity to upscale work, right? To get rid of the items that are searching and tedious, and really retrain your employee base to say, now that you have the baseline data, what do you do with that? So to all the students out there, I think really important to understand how data works and then how that can fit in so you can do higher level work and add more value. Tremendously important. And then I think the other thing that will come up more and more, if not already, is the flip side of AI. It doesn't mean don't use it, but there are risks that also come with it, including confidentiality. How do you continue to grow with technology if you don't want all your information out there with open AI and you want it in a closed ecosystem? Right, so do you go on Azure and then go off of what Microsoft is willing to offer? So there'll be those types of variations, and then cyber, which is a topic everywhere, will just be accelerated by AI. So none of this to say don't do it, but I think with the benefits comes, it's not this side compartment, the AI department. It's going to be inherent in everyone's work and change our behaviors. And the second piece is always risk management and cost management as you explore.
Mm-hmm.
So on the topic of disruptive forces out there, maybe Christina. So we're in the middle of, let's talk WeWork for a second. We're in the middle of seeing WeWork going through its bankruptcy, another restructuring process. As a company that has always been a big skeptic of that model. And let's move away from some of the obvious lessons about how you match assets and liabilities and as what really works. But are there any other sort of lessons learned from the approach that they took to kind of thinking about real estate as a service rather than just real estate as providing four walls and a roof?
So what WeWorks did a great job to spotlight is if you have a great product, you make it easy to access and accessible, there's a price, a premium price that people are willing to pay, right? And as Seth mentioned, the issue really came from asset liability mismatch, which is a whole other lesson. But you're seeing that value proposition piece come through in the markets today. So we have, broad, large spaces, full floors, typical model, tenant will come in and build it out. And then we also have pre-built product, which doesn't mean teeny tiny WeWork space. It could be small, but could also be 20, 30,000 square feet. And by pre-built, we mean we do everything. We make it easy for them, right? And a lot of companies, especially at that size, they don't have real estate staff. They don't want to oversee a build out. And so if you can provide the build out, the services, have a building that's well amenitized, modernized, be service oriented, and create a sense of community for them and their employees, people will come, and that's why that stuff is leasing, right? That's why that element of supply is leasing. So I think WeWork's put an early spotlight on it, but even in the continued space, whenever we talk about newer, older buildings, modern or not, it really comes down to what is that value proposition, and that is real. I think the days of, build it and they will come are over. And now the question is, how do you navigate away from build it and they will come in a higher cost of capital environment to create very competitive product? And I think that comment applies for office, but also for multifamily and in retail, where you have to constantly think about placemaking and experiential. You're seeing that in full force.
Let's talk a little bit about, so you all run real estate companies, okay, which is a little different than running a portfolio. And presumably part of the investment thesis for each one of your companies is not only delivering the returns available from owning real estate in a passive manner, but generating alpha from it. What are some of the levers that and the most impactful levers that you use to deliver that alpha? Maybe Eric, you want to?
Well, I think it depends on the constituent that you're talking about. I mean, in running a real estate company, a public REIT, the way I've always thought about it is, we exist to serve 4 different constituents. We exist to serve, obviously, our residents and creating the best experience that we can for the residents that choose to live with us. We exist to serve our communities where we are invested, and making sure that we're being good neighbors, and that the local elected officials and the regulatory officials in the market want us there. We exist as a company to serve our associates, our employees who work with us. And then fourthly, we exist to serve our shareholders. And we have to find, the way I think about it.
You didn't say the bankers in that.
No, they're in there somewhere, but sure. Part of the capital market stack. But we exist to serve all 4 of those constituents, and we have to find ways to create alpha or a value proposition really for all 4 groups if we're going to enable our company, our platform, to continue that relationship in a profitable way. With our residents, I mean, the most profitable lease transaction that we write, and we reprice the portfolio every year, but the most profitable lease transaction that we write is the lease renewal. And if the resident has not had a positive experience or doesn't feel value add in a hyper-competitive environment, that relationship will end. And we'll lose that opportunity to execute a renewal transaction, which is, again, the most profitable transaction we have. So, whether it's responsiveness in our service, whether it is the technology tools that we offer them to make life easy for them. We've just completely finished installing we own and manage about 102,000 apartments, and we've introduced smart home technology in all 102,000 units over the last 3 years. So you've got to find a way to offer a value proposition for each of those constituents. For the communities that we serve, we're long-term owners of this real estate. We're going to maintain this real estate. We're going to take care of it. We pay a lot of real estate taxes. We want them to want us there. Obviously, for our associates, it's about career, it's about benefits, about compensation, and offering growth for them. And then ultimately for our shareholders, it's really about trying to drive outperformance over a long period of time, and trying to take volatility out of the equation as much as we possibly can. But and I totally understand that markets can be cyclical, and different pockets of shareholders have different horizons. But we've always approached the business with an agenda to create outperformance and alpha, as you mentioned, for all 4 constituents over a long period of time.
I don't know whether this is a really good thing or not a good thing, but from my perspective at least, one of the things that I love about retail is I think we're the only sector I can think of at least, where it matters which tenants are next to each other. As long as you guys get paid in that apartment building or in that office building or whatever it is, that's what you're looking for. But if we can put the right tenants next to each other, we can create something better than just 1 + 1 = 2. And so there is a constant effort, if you will, and with us, frankly, it's our mantra, it's how we live, on creating the best possible mix of the most relevant tenants in a place, so that it's not just a Pilates studio, it's that lady that runs that Pilates studio that we have to go to because she's fantastic, and when you get your customers there, those customers are spending elsewhere. So that's a really important part, a constant part of alpha. Then secondly, now you've brought all these people to a piece of land for retail purposes. How do I intensify that use? What else can I do to create value there? And today, you're looking at a lot of parking lots and a lot of parking spaces and a lot of garages. And we're also in the middle of electrifying America and trying to figure out how to do that. How do we participate? How do we participate in the most productive way along those lines? The same thing with sponsorship. The same thing to make your place a living, breathing extension of your own backyard. That's what we're trying to do. That creates alpha.
So, Don, you talked about the current environment being one that's more ripe for opportunities on the acquisition side relative to development. I guess the question, and maybe Dana, you can hit this to start, Brookfield being one of the biggest developers over the long term out there, how do you look at the pros and cons of development now over a cycle, the cost of that infrastructure and keeping it there even when development may not make sense at a given point in time?
Yeah, wow, if there's any subset of real estate that is truly cyclical, it's development. So let me start with the cons, because I think that's probably easier for everyone to understand. Look, development is expensive. It takes a really long time. There's a lot of red tape. So it also means whatever timeline you plan for is probably going to be extended, because whatever zoning or jurisdictions you're in, if the environment changes. So you have to be able to make sure you have the right teams in place that understand where you're developing, what you're developing, how you're going to do it, what are your relationships with, certain contractors, certain government officials, whatever it may be. But if we think about like the most recent example of this, people that were starting projects a few years ago and were likely underwriting 2% interest rates, double-digit rent growth, wow, are they delivering in a very different landscape? And so when inflation goes to 9%, you've got it wrong. And so it's the risk profile, and it really depends on your appetite for risk and where you want to do it. On the pro side, if you get all those things right and you deliver in a great macro environment, wow, like you will get some of your highest returns. And Brookfield's been very fortunate in its tenure. We've done a ton of development projects that really have delivered for us. But I think now the appetite really is stressed more on that opportunistic type return. And really that's probably the only place you'll see us doing development in the near term, just because of the costs and the risks associated with it.
I think what you really have to do is on a public balance sheet, in terms of how at least we've always thought about approaching development, is just be mindful of what your upper tolerance is in terms of capacity. I mean, the idea ultimately is to create enough staffing, enough capability such that you have the potential at least to sort of continue building through the cycle, if you will. And for we're a $21 billion balance sheet. We've always earmarked our objective to keep our development exposure to something around 3% or so of enterprise value. We felt that was, after doing a lot of risk analysis, felt that was an acceptable level. So there have been times where we could expand our development operation and our in-house staffing, and we've resisted that tendency. And so now we'll probably have close to $1 billion under some form of development by the end of this year. which will deliver in 2026 and 2027, which we think is going to be a good time to be delivering. So as I mentioned earlier at the outset about the balance sheet, when you're managing capital for in long-lived investments and over a long period of time, and you're trying to outperform for these constituents over a long period of time, optionality is huge. And because there are external forces at play all the time, and you want to just have optionality. I see development as an option for how to put capital to work. And there are times where it's easier and more profitable. There are times where it's less profitable. But I think retaining that optionality is very important. You just want to be careful about how much you're willing to commit to it at any given time.
Is there a significant cost in just in infrastructure to keeping it, or is it one that you can kind of manage as a variable?
It's really mostly people and just overhead cost. And there are times when it can be productive, and there are times when it's less productive. Hopefully, when it's less productive, what you're also finding is an environment where you can start to bank some land, bank some sites, and be in a better position for when it does work.
Got it.
Let me add one thing to that, Eric, because I think you're spot on about the optionality. This is no time to develop. It's hard to make numbers work between construction costs with inflation. Rent has not caught up yet to those higher costs, et cetera. However, you can't just turn a switch on for development or down on development. I kind of look at it as a dashboard. There are times it's better to buy. There's times it's better to build. Right now, we're turning down the dial, if you will, on development and up the dial on acquisitions for the reasons we talked about. But when you turn the dial down on development, that doesn't mean you fire everybody and get rid of the development department. Because in times like this, it takes years to entitle, to get the right to build what you want to build, to design what it is that you want to build. Keep it going during times like this so that when inflation effectively catches up, which it will, rents catch up with those costs, and those costs moderate a little bit, you can hit the ground running. And that's, frankly, it worked beautifully for us coming out of 2008, 9, and 10. If we had shut it all off, by the time you get that gear going again, you just lost 2 years or 3 years. So you need all the arrows in the quiver if you want to create value in real estate over cycles. And just because nobody's talking about development today doesn't mean a developer isn't really busy in a number of these companies. They're just not hammering and nailing right now. They're entitling and designing.
And maybe to bring it full circle and come back to where we started, which is kind of the current environment. I mean, it's right now that I think a lot of us are seeing the most compelling opportunities to invest, because you do have these developers delivering projects where they're willing to kind of transact at a discounted price to what they underwrote because they need access to capital to either fund, the balance of their pipeline, or, they have a capital structure that they need to fix. So, it all kind of blends together, but to Don's point, you won't see a total stop, and it's all going to kind of come back full circle, and that's the beauty, and having a respect for the cycle that is real estate is really important.
Great. So maybe wrap up on one question. So we've talked a lot about the opportunity set out there, and including for people who are thinking about careers in real estate, whether it's development, whether it's in private equity, whether it's whether it's working in operations. We've also talked a lot about some of the risks out there, be it interest rates, be it the development risk. People talk a lot about cyber risk right now. It's geopolitical risk, et cetera. I guess the question for each one of you is, what would be the biggest risk item that would keep you up at night in your business? If you had to distill it down, maybe.
Oh my God. First of all, don't lose any sleep on stuff you can't control. The stuff you can't control, what are you going to do? You're just going to lose sleep on? Some stuff you have some moderate amount of control about. Can you get a lease done? Can you get an acquisition over the hump? Can you get a disposition closed? All that you can lose sleep over. Fine. All good. But how in the world are you going to impact it at all? And with respect to I just want to the students out here, Guys, go into real estate. Just because this is a time when everybody you know is either going into tech or digital marketing or something else, there will be a hole in the real estate cycle, if you will, for talent 10 years from now, 8 years from now, 12 years from now, that you will be in a wonderful position because not enough people are going into this business. You should be. Go in when it looks like it's a tougher time. You'll be learning on somebody else's dime. You won't be risking hardly anything of your own, so that 10 years from now, when you know something and it's a good opportunity, you can make some bank. Come on, get into real estate.
Yeah, we're going to end on a high note. I'm not even going to answer that question.
That's great. Great. Well, thank you very much. Appreciate it.
I couldn't help that.